How would you like to invest like an institution? Well, today's guest is Pascal Wagner, and that's exactly what he's able to do for himself and others who want the passive income playbook. Now, Pascal used to work at a tech VC firm, and what he learned there helped him understand how to invest like the professionals. And it's not starting with the deal, which is a huge mistake so many investors make. If you want to learn how to invest the right way as a limited partner and be a passive investor, this is a conversation you don't want to miss. Check it out right here on Multifamily Insights. When you think you found a great deal, asking the right questions could be the difference in finding a stud or a dud. Listen, we've put together a new guide to help you out. It's called 7 Questions You Must Ask Before Investing in Apartments. Now, in this guide, you're going to learn how to uncover red flags, quickly identify underwriting risk, vet sponsors and team members, and confirm key assumptions. Now, this is a guide that's going to help you be a better investor, whether you're an active investor or you're a passive investor looking to partner with other operators. Asking better questions is the key to identifying great opportunities. So download this free guide. Go to our website, casmoncapital.com/7 questions. That's the number 7 questions. And you can access this free guide today. To make it easy on you, though, we've put a link in our show notes. So you go to the show notes, you can click that link and access the guide right now. This guide's going to help you make better investment choices, asking the right questions to build your portfolio. So be sure to download it today. Pascal Wagner is a former venture capitalist turned real estate investor, mainly a passive real estate investor, who has built a $250,000 a year portfolio through over 30 investments. Now, as a VC at Techstars, he deployed $150 million into 300 companies where he learned how top financial institutions analyze deals, manage risk, and make smart investment choices. Let's welcome to the show, Pascal Wagner.
John, thank you so much for having me on the show.
Yeah, absolutely. What I didn't read in your bio is that you are a fellow co-host for the Best Ever Series podcast. And I've been able to do that with my Multifamily Mastery show as well. And I love some of the insights and the conversations you get to have on that show. But for our listeners who aren't familiar with you and your background, why don't you take 2 minutes to fill in some of those gaps?
Yeah, cool. So I would say maybe I'll start with when I was 23, was slowly just building up cash from running a Facebook advertising agency, and I bought my first pieces of real estate. I bought single family homes that I rent by the room, and I've been doing that for over a decade now, and kind of I've been doing that concept, some in Austin, some in Charlotte, some in Atlanta, and that part will be relevant later. But at one point after I sold one of my companies, walked through to kind of a national photography firm, I went and joined a venture capital firm called Techstars. They had invested in our company, and so I knew them really well. And I joined the firm because I wanted to learn how to be a better investor after that exit. And so I got to spend 3 years there. As you mentioned, like I got to basically be in the front row seat and learn from the chief investment officer who just finished raising this $150 million fund. And I was in the front row seat of trying to figure out who were all the companies within the portfolio that we needed to, that we were looking to invest in. And so that's why I learned a lot about how institutions think and how they think about deal flow and their due diligence process and what that actually looks like. And while I was there in 2021, my dad had passed away. And that's when everything shifted for me. I had to then figure out, my mom doesn't know anything about finance or, investments. And so it really fell on me to figure out how to provide my mom an income in her retirement from the money that he had left her. And so one of the first things I did was I invested in more of these co-living homes that I mentioned earlier. I ended up selling everything, consolidating it all in Atlanta, and have 11 homes, 94 units at this point. And I realized that I had all of our income that was, my mom was relying on in one city in one asset class, and I was one hurricane away from, you know, basically putting my entire mom's future in jeopardy. So uh, that made me uneasy, and that's when I realized, like, okay, I have to diversify then, outside of just my own portfolio and my own strategy. And so I reached out to financial advisors and asked them, like, what products do you recommend? And after talking to three different ones, you start to realize that they're all compensated based on the amount of money that you invest with them in the stock market. And they're not incentivized, they're actually disincentivized to have you invest in alternatives. And so I realized I had to learn all of this kind of myself. Thankfully, I had a background in venture capital. I worked at a fund. I understood the concept, and in GoBundance, I had a ton of people that I knew that lived off of their investments, and it was from them who I'd ask, like, who are the people who you like working with? Why do you invest in this fund? And kind of just learning from people who are actually living off of the income from these investments. And so kind of over the next couple of years, as I mentioned, after my dad passed away, I was kind of piecing it all together, trying to figure out where do I invest this capital in order to have consistency. And I mean, we can dig into a lot of the lessons learned there, but I would say um, that experience of trying to piece it together, and there's no one that sits down and teaches you how to be an LP, or how to confidently invest in these kind of private equity deals. And so that's all that's, today I've invested in over 3.3 million across 23 different LP deals. And then I also have those 11 homes in my portfolio, and they both produce about half of that $250,000 a year in income today.
Yeah, Pascal, I love it. I appreciate the background. Sorry to hear about your father passing away, but I think it's a great lesson for our listeners because you could be doing well by yourself, right? Doing your own thing, especially if you got a long runway, but life happens and you may get, responsibilities thrust upon you that maybe you're not prepared for. And it's one thing to invest for yourself. It's another thing to look at, aging parents or siblings, godchildren, like other folks who, may need help and may look at you for help. And you have to figure out how to make this thing work for everybody, right? So I appreciate you sharing that journey. A couple things stand out to me, right? So first of all, obviously you're a bright young man, creating businesses, launching them, selling them at 23 years old. Like you're obviously doing way better than I was starting out. So you had that going for you. You're working at Techstars. You have a front row seat to how these large organizations, these venture capital firms, they look at deals, they analyze deals. We're going to come back to that. But from there, you had your own personal situation with your mom trying to figure out how to make these investments and how to diversify those investments. And you said something about, as you looked for guidance, you talked to other people and financial advisors, and you realized they were not giving you the advice you're really looking for because most of them want to have your money tied up in stocks. And that's something I think so many people, until you really dig deep, you don't realize that these financial advisors, no, I'm not knocking them, by the way, but they don't have an incentive to really help you optimize your income, right? Their job is to sell you the products that they can sell, which are typically going to be stock or mutual fund type products. And it's tough because if you look at a well-balanced portfolio, you look at the way things have changed, we know that there are other asset classes, alternative assets that certainly are important to have in your portfolio, certainly can hedge against inflation. And we all know real estate has a great it's a great vehicle to produce wealth in this country, but that's not a product they're ever going to recommend if they don't have some sort of incentive or reason to do that. I want to go back though, right? Because as you've grown as an investor, you've kind of paired your experience at Techstars and figured out, how to analyze and evaluate deals. You've been an LP in over 23 deals yourself. When you think of deal flow in analyzing deals, what are some of the lessons you learned that really help you today when it comes to evaluating opportunities?
I will start by how most investors, probably if you're listening, how you probably do it. and how I used to do it when I first started in the world of investing, and I will share with you how I do it now. If most people that come through my door in my coaching program, especially, I see this over and over, is um, everyone brings a deal that has come into their inbox. They've gotten a referral from a friend, or maybe they signed up on an operator's list and they're getting a piece of deal flow, like an opportunity to invest in, and they are looking at that deal in isolation,
Mm,
trying to figure out what questions do I need to ask? What do I need to do in order to know if this is quote unquote a
a
good
good
deal?
deal.
And that is fundamentally the wrong way to approach it. So when I was now I'll kind of wrap in what I do now and where I learned it from. So when I was at Techstars, um, he, this is the formula that we would use. We would start with, what is our investment thesis? When this $150 million fund, they're raising like 30, $50 million checks from like the Texas Teachers Pension Fund and and they have to like sell them on a strategy. And so at that fund, it was like, we're only gonna be a follow-on investor. We're never gonna be the biggest check writer. We're only gonna participate in deals that are at least 700,000. And so they had a thesis. And so like immediately, then what happens is you have specificity in what you're trying to achieve. And when a deal comes in your way, it's highly likely that it won't fit. Most deals, once you have this thesis, the very basic high level thesis, um, then what you realize is that it becomes about deal flow. It becomes about seeing a whole bunch of opportunities and weeding down the 500 deals that you might come across in a year down to the top 2 to 4 that you invest in. And I think that is how I approach my deal flow today. I could give you numerous examples and talk through it. Like the same thing I did with my co-living strategy. I would say I'm looking for single family homes that have at least 2,000 square feet, that need to cash flow at least 15% cash on cash when they're stabilized. And so that was my thesis there.
Pascal, I love it, right? Because that's exactly what I see from investors, right? They find a deal and they start with the deal. They're analyzing this deal, whether it be someone they knew, an operator, but I don't and I always have the conversation because I feel like they start the process too late. And they're thinking about investing, but they don't take the next real step until there's a deal on the table. And I always think that's too late because at this point, now you're trying to make a decision about something live. And even if it is the right deal, you may not be comfortable and confident enough to know that because you haven't put enough reps or you haven't gotten that clarity on what it is you're looking for. And by the way, if you want to know what questions you should be asking when you're looking at a deal, we have our free guide, 7 questions you must ask before investing in apartments. Go to casmancapital.com/7 questions. Pascal, I love what you hit on because if you flip that dynamic and you get clarity on your own investing thesis. What kind of deals are you looking for? It's naturally going to weed out 95% of the deals that hit your inbox. It just will. It's not going to be in the markets you like. The size is not going to be right. The vintage or the age of the asset's not going to be right. And when you're a newer investor, you don't know these things. And part of the challenge is you don't know the criteria that you should or shouldn't be using. I remember when I first started in this space, going from, my smaller 2 units, 3 units, 8 unit building, the first syndication deal when I was learning about it, everyone said you want 1980s or newer, you want, garden style apartments, you want pitched roofs, you want this, you want that. And I didn't understand the why behind it. I was like, well, why not? Why don't you want a pitch roof? Or why do you want a pitch roof? Because I was in Chicago where everything is old and everything was flat roofs. and nothing matched kind of this criteria that I was reading from so many other experts. So I had a hard time really figuring out what my criteria should be. As you kind of lay that out for yourself and some of the other LP investors who come to you for coaching and come to you for help and guidance, how do you help them frame up that criteria and how do you do it for yourself?
Yeah. So this is the first thing is asking a series of questions. So I run people through this process where I'm really trying to understand um, the macro and the micro. So I think let's start with it's a two-parter. So the first thing you need to do is step back and say, like, we are taking the scientific method approach to investing. That is what every professional investor does. And that is what you as a retail investor should be doing. You should have a hypothesis about what's going to happen. So for me, before I make an investment, the first thing I'm trying to figure out is like, okay, do I want cash flow or am I trying to grow my equity? There are two different buckets. Let's say with like I'm trying to grow my net worth. I have 100K. I'm trying to turn it into 200K. What do I think? I follow Warren Buffett's principle. Like, what can I buy that I would never sell? And like, what are big macro trends that I think are happening over the next decade that I believe are inevitable? It's not like that I think will happen. It's what do I think is inevitable? This is how I got one of my first big winners in stock investing. Um, Back in, I don't even remember I think it was like 12 years ago now. Um, I One of the big bets I made with my dad is we put 100K into Tesla, and we said, what do we think is going to be inevitable? We think that inevitably cars are going to move to be electric. And so there were no other people making electric cars at the time. Toyota and GM and Ford weren't even thinking about it. The only player in the space was Tesla. And so that was a big bet we made, and that turned into 1.5 million 10 years later. Um, I think it's starting with the big theme. What do I think inevitably will happen? If it's multifamily, if it might be like, okay, it's 2025. We've realized multifamily are very interest rate sensitive. I think that because of deportations and focus on that kind of stuff, whether you like it or not, will reduce the demand for housing. So maybe multifamily, maybe not the big trend I would invest in over the next decade. Okay, but Trump is trying to bring manufacturing or industrial back to the United States. Okay, what is a inevitable long-term trend? The US wants to be America first. They want to invest in and onshore everything so that for safety and security. That sounds like a good bet to invest in. Cool. What can I invest in that aligns with that macro theory? Okay, I could invest in industrial. Maybe I could invest in, maybe I would invest in multifamily with that. If you're thinking that more people are going to be brought. See, I think you have to think about the big overall trend. That's the macro. Then the next piece is the micro. It's like, okay, what are all of the possible players and what are they all projecting? Like, let me look at the top 10 deals or asset classes and just see which ones do I think are going to perform better or not. Do I want to invest in funds or syndications? Do I want to invest with a emerging manager that's done less than 10 million in deals, or do I only want to invest with institutional or somewhere in between? Do I want to focus on debt or do I want to focus on equity based on the amount of risk that I want to take? I think and without someone sitting you down and walking you through the process, of course you're going to be, you're going to wonder why I'm investing in these things. Why are some of them hitting and others are not?
I love that approach, right? You're talking about investing like a professional investor, right? Like the big boys, the VCs, taking a scientific method, breaking down both the macro and the micro. And I love that point you make about what's likely to happen over the next 10 years. And I believe that's a great framework for investing in general, is just stepping back and saying, hey, what are big bets we believe in over the next decade? It's 2025 now. Between now and 2035, what's likely to happen? And where do we think we should make investments, whether it's in real estate or elsewhere? What are the things that we feel are going to be big bets? And looking at that from the macro standpoint. And then as you get to the micro, it's understanding, okay, what asset classes are poised for growth? Am I looking at funds? Am I looking at direct syndication investments? Am I looking at maybe, again, just smaller portfolio? Am I looking at hotels or Airbnbs? There's all these different things, right? Equity, debt. There's a lot of different ways to think about it, but you do have to go through that process and get clarity. To your point, I know that you would have to sit someone down and walk them through step by step. Most people do not do this, right? Most people just say, hey, I want to invest in real estate. Sometimes they don't even know why. They just heard you can make money in real estate and they start looking at deals. Can you maybe elaborate a little bit more on kind of your own personal journey and the experiences? Because you mentioned that you kind of started that way as well. Walk us through some of those investments you made as far as, when you were just kind of looking at the deal and making that decision versus now this more scientific approach that you take.
So I think in the beginning, my my rules, I wanted to just not lose money. And a huge amount of
That's
pressure.
a
You've
great
got
rule,
to,
by the way. Don't lose money. That's a great rule.
yeah. I mean, it felt a lot more intense with, it was like a couple $1,000,000. It was the most I'd ever needed to invest, especially at one time. And it was for my mom. And if I messed it up, she could end up on the street, or it's just the pressure was crazy. So I think that was my first approach. So I focused on investing with institutions, and I think even still today, I still think that is a great. Um, I think if you are new, like I like investing with the big boys. There's so many risks that you just really don't understand with an emerging manager. Um, I think there's a lot of benefits of going with emerging managers. The returns can be better, the splits are better. But I think, with institutions, they're usually not just taking retail capital, but they need to have the reporting and the controls and the audits and everything in place for their other institutional family office investors. And so I think I think that's that's even a strategy that other investment funds in the venture capital world do. There are two types of funds. You are either a lead, you are a person who does the due diligence, and um, you say, I'm going to lead this round. Here is the price I'm willing to invest in that. And then there are the other types where there's follows, and so those are people who are like, hey, I love this idea, but I'll only invest if you can find a lead. And I think a similar thought process is here. Like, I think we should be following what the family offices are doing, right? Because it inherently it is you as a retail investor are not going to do nearly any amount of due diligence than a family office would. And not saying that you're not going to lose money that way, um, but you just have to think about who's putting in more work and has more at stake. I want to follow behind someone like that.
I think it's a great way to look at it. I'll say it a little differently too, because when you're following a large investor, that large investor has done it enough times to have a more robust process, and they've probably lost money on some of these deals, right? So when I think of that criteria, I know for me, that criteria comes from experience. And that's what typically happens with most people is like, you're not just making up rules to make them up. It's like, hey, we want to follow because guess what? We led and we lost a lot more money because maybe we missed something, or maybe it was, there was something that we didn't recognize, but we realized that's not our strength, right? Maybe our strength isn't that due diligence and sitting there and really stress testing this idea. So we'll let a firm who has that skill set and that capability, and that is what they do really well. They know how to vet operators. They know how to ask the right questions. They know how to look at a property or run the data on the market. Let's let them do all that work. We still got to do our own due diligence, But I feel way more comfortable if that group has done that work and they're investing in the deal and I'm following them, right? When it comes to a property, same thing. I learned why people, say they want pitched roofs versus flat roofs. Guess what? If you have to redo a flat roof, you got to do the whole roof. There's no shingles and little patchwork. There's no solutions there, right? So you're dropping 25, 50K, whatever it is, on that roof. And there's not a way around it. It's not like you can just go and patch the shingles. So these little rules, these criteria that people create, they're guardrails because somebody has run into this issue at some point in the past and they've realized this is something they don't want to fix. When it comes to the vintage, that was something for me that I struggled with for a long time because I just didn't understand why people picked this arbitrary year, 1980s, 1978. Well, I can tell you why. One reason is for asbestos and lead paint, which 1978, they stopped doing that stuff, right? So anything built before that, you might have a chance of that being there. So then you have to look and see if those properties have been remedied. The electrical, sometimes they use the old knob and tube electrical, right? So you start to learn these things when you buy a property and you have to replace these things because maybe you didn't know the right questions to ask in the first place. So it's one thing to develop your own criteria, but I think there's a humility that's necessary to recognize you simply just won't know the right questions to ask. And that is why it's important to work with experienced investors out of the gate, whether that's institutional level, even if it's an emerging operator, that emerging operator who has some skin in the game, who's got some deals that they've gone through, you just need to be with someone who has the experience to understand and navigate these deals because there are questions you won't even think to ask that they've already used as a criteria to either walk away from a deal or to recognize that this is a great opportunity. And that's where, as a passive investor, that's where the gold is. The gold is aligning yourself with someone who is further down the pathway, more sophisticated. It's not just that they're going to do the work. And I think that's what a lot of people start with is, oh, okay, I don't do it. They're going to do it. That's a starting point, but it really should be someone who has the knowledge, the expertise, the experience to understand how to navigate that deal and understand and recognize the challenge. And once you have that, that's going to alleviate a lot of the issues that may come up.
Yeah, I mean, I just think that there's uh, in another way I think to just have more clarity on that is that um I think it's important because you know what type of due diligence process they do. I hear a lot of people say, "Oh, I this person's investing in it, so it must be good," or I trust they've done their due diligence. I think it's verifying and understanding what that due diligence process is. That's what all the professionals do. Um, and I think that's a key caveat and nuance there.
I love that, right? Because they're going to do that due diligence. And, we just did our first deal with an institutional investor. And yeah, that process is way different than with our retail investors, right? They're asking for a lot more history. They want to see deals. They're going to ask you questions about the deals that you've done. And if you don't have experience, they're not even talking to you, right? I mean, like that's prerequisite. You can't even sit down with them if you haven't gone full cycle on a handful of deals. So that in and of itself is a great step to start building that due diligence. So if you're an LP investor coming behind them, it makes it a little bit easier. Let's talk more about kind of the portfolio today. So now that you've developed kind of your framework of what kind of deals you're looking for, what your criteria is, how has that shifted? What were you doing maybe before that uh, you're not doing today, or vice versa?
I think I have learned quite a bit about what investments I like to make and which ones I don't. I very much think of my portfolio as what bucket is this investment in? Is it in my I'm trying to grow my equity bucket, or is this is trying to provide me cash flow bucket? And I've found two reliable sources of cash flow in terms of investments. The first is my co living portfolio, where I rent the single family houses by the room. And the other model is private credit and debt funds. I've invested in like over $600,000 in different oil and gas, multifamily, development, retail, self storage. You name it. I've done a bunch of these investments, and they some of them provide cash flow. But the way that they are designed is not for to provide me cash flow, and they're also I found that there are better vehicles for me to multiply my money than in real estate. I think that's been kind of the big learning for me. Uh,
On the
you know,
equity
I,
side.
on the equity side,
Yeah.
if you think about a standard deal, the fund manager or the operator really gets paid on the exit, and so they are incentivized to uh, have a deal go full cycle, right? And so if you think about like a value add deal, which is like the big thing I think investors like to invest into, is this concept of value add. Typically, for the first 2 years, you're renovating, and so there's very low or little cash flow, if any at all. And then once it has been refinanced, you get a bunch of capital back, and then it's cash flowing maybe for 2 or 3 years. But that's not. It's very difficult to build your life and your expenses around that type of return. Like maybe the refinance happens much later or not at
Yeah.
all,
Yeah.
or and then you kind of realize like that's really more of an equity play. Like the operators get paid on the equity, so really it's an equity play, no matter how much it kind of
Yeah.
does cash flow and equity growth. And so for me, I like investing in. I've realized that I like investing in high risk equities, or high tech stocks like Tesla, or being in cryptocurrencies, and I just find that those give me, a much better return for what they're different kind of risks.
Talk to us about how you built that portfolio, because I think it's interesting. You mentioned the cash flow and equity side. Those are kind of the two main buckets that you're looking at. And most people, myself included, could make the argument that, yeah, value add investments, they play in both buckets. But to your point, they're not, it's like anything else, right? When you play in both, you're probably not stellar at either one, right? You're not going to be the best at either one, but you're nice in the middle. And I think for a lot of people, particularly when you're starting out and maybe you're not as clear and defined and maybe you're not as well capitalized, you need kind of that blend to get started. But for you, are you using other like investment when you say buckets, like are you using different accounts like retirement accounts or anything like that? Or is it all liquid cash that you're using to invest in these different buckets? I'm curious of how you kind of structure your portfolio there.
Okay, so very interesting topic. So uh, I think maybe a underused strategy, that depending on the type of relationship you have with your parents. But my mom completely trusts me, and I actually now have like a quarterly financial meeting with her where I show her where everything is, and but I've structured that a lot of all of my long term investments my mom owns. Um, and anything that is kind of more short term or generates cash flow is something that I own. And the reason, and I'll add, like, then there are things in my retirement account, like my Roth IRA, that are also incredibly long term, right? And so, when I think about crypto, for example, I'm thinking about long term planning. I know that in 20, 30 years, whenever my mom passes away, that I will inherit anything with a step up in basis. Um, and so basically that means like if the stock went up from 100K to a million, instead of having that 100K being your base, it's now at the million and you can sell and it be tax free. And so all of my long-term assets I've put strategically in her name so that at some point I can inherit them tax free. And then short term, I have everything with cash flow that meet the family's needs. Um, in my account. And so those are some of the some of the ways I've structured it. Um, I think once you become an accredited investor, I think you slowly need to start thinking about risk and liability. Like, um, you know, I don't really own anything. If you think about all the top celebrities, like there's a holding company that has all the investments, and they're not in my name, and so if I, get, I get into a car accident, or I do anything where, or I don't know, someone just wants to sue me, that I don't really have any assets or anything that someone can come after me for. And so I think there's a lot of, once you start getting to that stage, those are the types of things that you need to think about, because I mean, I know people who've had, um, you know, hacks, and they just haven't gone through full asset protection.
Yeah. I appreciate that because it's important to understand that there's multiple levels to this, right? Obviously, we're talking about passive investing primarily, but there's also asset protections. There's understanding how to pass along assets, and, whether it be, um, thinking about, we always talk about generational wealth, but it really comes down to understanding how you put the right systems and protections in place so that everything is secure, and you have to have the estate planning set up as well. You have to have all of these things in a way that allows you to maximize the benefits. And your point there on, putting those assets in your mom's name, the long-term ones, it also gives you time, right? If some of those things hit, great. If they don't hit, okay, at a minimum, you have a higher step of basis so you can minimize your losses, but you're using the cash flow to take care of the day-to-day expenses, right? And I think that's a great way to start, right? When we talk about, how to invest. For a lot of people, if you're working a W-2 job, that job is probably your quote unquote cash flow today, right? So you can invest for the long term, you can invest for equity. But if you are looking to transition, then yeah, you're going to need to start to replace that cash flow through other investments. So it's a great way to start thinking about how to invest, even if you keep it super simple and just say, hey, is this an equity bucket or a cash flow bucket? That can give you some range to say, okay, what kind of deal should I actually be looking into? So I love the way you break that down. I think it's very helpful for our listeners to understand how to think like you think, but also like an institutional level investor. Hey, one last thing, thinking about your time at Techstars, right? And seeing all the deals that you were able to be a part of or see come through. Give me one or two that were an absolute winner that maybe you didn't expect right away, or the other way, one or two you were, gung ho about, and you're like, oh, this is going to be amazing. And maybe it just, flatlined out.
So I think it's still too early to tell. Venture capital is one of those games that's like a 10-year plus cycle. But I will tell you that, I think the key whenever you're investing or doing anything is, what is your unfair advantage? What is your edge? Or are you investing with someone who has an edge? I'll give you an example. So, my job was literally to figure out who are all the companies that were raising capital, um, and I got to look at every single one of their pitch decks. I got to interview the founders. I got to review their board meeting minutes, their financials, their balance sheets, their forecasts, um, see all their recent investor updates, and it became very clear who the winners were, especially after reviewing over like I think 2,000 deals during my time there. Right,
Wow. Yeah.
like when you review a lot of deals at the beginning, every deal looks amazing, and then you start to realize like, oh, all of these are kind of the same. And then there's a few outliers that really are growing incredibly quickly, or going gangbusters. And so I think first, like only by looking at a lot of deals do you get that skill. So I think that's an important thing to think about as you are on this journey. But also, I got insight into what companies were raising money and which ones are blowing up. And so I got to, um, first, I would go to my Monday investor meeting with my chief investment officer and say, hey, here were the top 20 deals from last week. We passed on these 18. Here are the two that I think we should write a $150,000 check into. And they would basically sign off on it. And from there, like I, one, found which deals would match their thesis. And then I could, in this one deal with kind of pad split. It's a marketplace for co-living, like these rent by the room strategy. It's kind of like Airbnb, but for this co-living model. And and through that, I like flew down to the founder's house and I basically pitched him on why he should let me invest. And so I got front row, rare, unique opportunities to invest in deals just because of where I was sitting. And so I think it's important that when you're investing, if you don't have an advantage, it's to find someone with one, um, and to over time develop that skill on your own.
Pascal, I love that, right? You're talking about develop that unfair advantage, whether it's connections, whether it's access, whether it's a skill set. In your case, you were reviewing these deals every week for your job and you were already doing co-living. So when those two kind of came up as an opportunity, you had a very unique unfair advantage for that particular deal. But I think it also goes back to us as investors, figure out where you have that advantage. And it doesn't have to be that dramatic. We're primarily talking to multifamily investors. As a multifamily investor, where do you have an advantage? Is it submarket? Is it a certain asset class? If you come from the medical field, maybe you have a certain, unfair advantage there. But figure that out because that's going to allow you to stand out, to do more deals, to win, to you know, play the game at a better level than what your peers are going to play. And I think that's really important, especially in an environment where things aren't going as well across some of these deals. And people are looking for operators who know how to execute and know what they're doing. So kudos to you and what you've done. And thank you for sharing that information for all of our listeners. Hey, if folks want to reach out, what's the best way for them to get in touch?
Yeah, so I have a freebie that I give everyone. I talk a lot about deal flow, and I have a kind of an offer where for free you can see all of the deal flow that my family office has, and we update it every Friday, and you get an email every Friday with the top 3 deals. So if you're trying to get in front of a lot of deals and see what good looks like, I encourage you to go to passiveinvestingstarterkit.com. And I'm also on LinkedIn. Come say hi. That's my primary platform of choice. And then also, as you mentioned earlier, I am one of the rotating hosts on the Best Ever Show. So be sure to tune in on Thursdays for the Passive Income Playbook with me.
I love it. Pascal, let's move on to our round of insights. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmoncapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmoncapital.com and click on the mastermind button today. Give me a failure or an apparent failure that sets you up for later success.
Oh man, I think pick which one. I talked about my first big win of investing in Tesla a long time ago. I will tell you that the first stock that I invested into was Jamba Juice because I liked going there. I knew what it was like. I thought it was going to be a big thing. When I was like 18 years old, I didn't know any different, and I lost my first $6,000 out of 10 on that stock, and so I very quick. I mean, that's what made me want to become a much better investor. Yeah.
All right, appreciate that. Give me a digital or mobile resource that you would recommend for our listeners.
The Passive Investing Starter Kit.
There you go. All right, give me the book you've recommended or gifted the most in the last year?
I actually have. I really like giving Atomic Habits by James Clear.
It's one of our favorites. Love that book. All right, give me a daily habit that helps you stay focused on your goals.
Oh man, I think planning my day the night before.
All right. What's your number one insight for building a passive income portfolio?
Find someone who's doing it.
Love it. Love it. All right, let's lighten the mood, man. Where are you located?
I'm in Miami, Florida. I just moved down here from Denver a year and a half ago.
All right, Miami it is. Give us your favorite place to grab a bite to eat.
Oh man, I just went to Shiso here in Wynwood. It's a Japanese sushi place. They have they're a great spot. Tons of incredible food here in Miami, so hard to pick.
All right, sounds like a great option. Well, Pascal, appreciate you coming on the show today and breaking down some of your insights. A couple key takeaways for me, man. It's really about investing like an institution, right? Think like a professional, understand the macro and then the micro. Where are the big bets? Where are the big trends? And if you are focused on multifamily and real estate, think about it from that standpoint too. Like what's happening locally, what's happening in the markets, like what are people looking for? Recognize this, and that's going to give you that unfair advantage to succeed as a real estate investor. You also talked about really just getting clarity of what your criteria is when you're looking at deals. That's going to allow you to be a better passive investor, to identify the right opportunities for you, and to ultimately achieve your own financial goals. Again, for folks that want to connect, you can check them out on LinkedIn. He also has the Passive Income Playbook. We're going to put a link to that in our show notes. Pascal, thanks again for being a great guest and coming to Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.